I, Jerome Powell, solemnly swear not to hike rates any further in 2024. Well, we all know that's not exactly what Powell said, but he did say that it is not likely that they will hike any further, which in turn caused the 10-year treasury to drop below 4% and sent mortgage rates sliding below 7% for the first time since August. So what exactly has happened over the last couple of weeks that has caused the Fed to change their tune on the future of inflation as well as hiking interest rates? Well, that's exactly what we're going to talk about in today's video. We're going to talk about the latest data that shows what the Fed has done over the last 2 years has actually worked to help bring inflation down. In addition to that, we're going to talk about what the future of inflation looks like, how the Fed is likely to respond, how that might affect interest rates, and what that means for you as a buyer or seller in the 2024 housing market. So the annual inflation numbers are in, and inflation has cooled for the third straight month at 3.1%. So even though inflation increased by 0.1% month over month, which was a bit higher than the expected, once the Fed rounds those numbers like they do every single month, we actually had the inflation numbers coming in exactly as they were anticipated. And that's something that you have to remember in the way that these numbers are calculated. What the Fed does is they take every single month over month number and they add them together to create a yearly number. So as you can see from this chart here, last November we had a 0.2 and we just replaced it with a 0.1, which in turn allowed inflation to drop by 0.1%. But here's the thing, inflation is still slightly elevated at that 3.1% because the Fed's target is 2%. But if you look at the chart that we just posted there and look at 3 of the first 4 months of 2024, those numbers are significantly higher than the month over month prints that we're currently getting. In fact, if you add January, February, and April, that's 1.3% of the current 3.1% inflation. So based on this, Q1 is when CPI will really start to fall and could ultimately force the Fed to acknowledge that inflation is no longer sticky. If we look back the previous 2 months, we had a 0% in October and a 0.1% in November. So assuming that trend continues, we're going to replace a 0.5% in January with a 0.0 or a 0.1%, the same in February, and then once again in April. So in theory, if we replaced all 3 of those months with a 0.1%, that equals 0.3% that we're adding, and we're dropping 1.3%, which means inflation would essentially be sitting at 2.1% by the end of April. Now you're probably watching this going, Jeb, how can you be so confident that we're going to get lower month over month readings going forward? Well, one thing we can do is we can actually look at the Q4 GDP readings from the Atlanta Fed now, which in turn shows that GDP is trending lower, currently sitting at 1.2%. Now growth in GDP typically results in higher inflation numbers, more or less due to high demand and a lower number of supply. But what we're seeing is the opposite, with GDP numbers actually trending lower now, which means inflation should continue to moderate. On top of that, we have shelter, which we've been talking about for the better part of a year, which makes up nearly 35% of the CPI numbers. And at the moment, it's still running at a lag, sitting at 5.5% year over year. And as you probably know, if you've been paying attention out there, rents are no longer rising. In fact, in many markets out there, rents have stabilized and in many cases actually gone down, which in turn means as that lagging number starts to catch up, it's going to allow inflation to come down in a more meaningful way. Now, I've seen people out there say, hey, if you took that CPI shelter number and actually put it at 0%, because that's essentially where it should be with rents no longer rising, then in theory, you've had inflation under 2% going all the way back to May. But the reality is you can't take it all the way to 0%, at least yet. But what I think is important to note here is that rents are declining in most markets out there, and the shelter data is still showing a 5.5% increase year over year. So we know that's not accurate. So when we look at it from a bird's eye view, we know that the inflation numbers are actually higher than they should be reporting. And this is one main reason that I believe the Fed is starting to lower its inflation forecast for 2024, along with seeing core PCE falling to somewhere around 2.4%. As I mentioned earlier in the video, Fed Chair Powell came out this past week and made some really big statements that led the market to believe that they wouldn't only cut rates 3 times like the dot plot shows, but rather they might cut rates as many as 6 times in 2024. Now, as we've discussed in other videos, the Fed's not only looking at inflation, they're also looking at the employment numbers. And while the non-farm payrolls came in higher than expected, and this past week we saw jobless claims come in better than expected, the market more or less shook it off because now the Fed has more or less given the market some ammo to believe that rate cuts will definitely happen in 2024. And this is something that the Fed was really trying to avoid this entire time. We talked about them not wanting to front run the markets. They don't want to come out and make statements to the market to make them believe that they're actually going to start cutting rates. Because if they do that, there's a really high likelihood that businesses and traders go out there and front run those rate cuts. Because if they know they're coming and they're borrowing money based on short-term interest rates, as the Fed starts to adjust those rates, that means that money becomes cheaper for them to borrow. And what can happen with this is as businesses start to borrow more money, they start to spend more money, and in turn that could lead to higher inflation down the road. And that's another reason that the Fed has said that they want to keep rates higher for longer. They want to keep this restrictive monetary policy in place for longer to make sure that inflation has completely been stomped out, if you will. So while you can see from this chart here, the interest rate traders are expecting a 63% chance of a rate cut starting as early as March, you have Fed Williams clearly pushing back, saying that it's premature to be thinking about a rate cut in March, even going as far as saying that we really aren't talking about rate cuts right now, which in turn is contradictory to what Fed Chair Powell said this last week, as he noted that the Fed discussed the timing of rate cuts at their most recent meeting, and also saying that there was a general expectation that rate cuts will be a topic of conversation going forward. And with that, we saw the Dow surge to new highs and mortgage rates drop into the high 6% range for the first time in many months. So what does this actually mean for the housing market in 2024? What does this mean for you as a buyer or seller out there in the market? Well, as we've discussed before, for every 1% drop in interest rates, you add about 5 million potential buyers to the market. Now, we know all 5 million of those potential buyers aren't going to go out and buy a home, but it does add additional competition to the market. And if you've been paying attention, inventory in most markets out there is still sitting near record lows. So now you have more potential buyers added to a market with a lower level of inventory. Now, I know what a lot of you guys are thinking. This means that housing prices are going to surge higher. And honestly, I don't believe that to be the case. And the primary reason for that is housing affordability. While this drop in rates is going to improve affordability to some degree, it's not likely that we're going to see any crazy appreciation like we have over the last couple of years, just because there's less able buyers out there in the market. And I don't believe interest rates are going to go low enough to change housing affordability in any meaningful way. Redfin just noted that the housing market is already starting to pick up with this recent drop in rates. So a question that a lot of you are asking out there is, if the Fed does cut rates 3 times, 4 times, 5 times, 6 times, whatever that number is, and they do 25 basis points each time, well, 3 cuts is 75 basis points. 6 cuts is 1.5%, which takes the Fed funds rate from 5.5% all the way down to 4%. But that in no way means that interest rates are going down to 4%. In fact, the market has probably front-run some of these rate cut decisions, even though they haven't actually happened yet, which means that rates have probably dropped a little bit faster because they know that the Fed is going to do some sort of pivot in 2024. So as the Fed starts to follow through on what we know that they're actually going to do, which is at least 3 rate cuts based on the data that we have right now, that means as we see those rate cuts actually happen in real time, you're not going to really see a meaningful move in mortgage rates when that actually takes place. And the primary reason for that is because the market was anticipating it. And that's something that we've been talking about over the last couple of years, is the Fed likes to be honest with the market to some degree. They don't want to front run the market, but they do want the market to kind of anticipate what's going to happen. That way volatility isn't completely out of control. When the Fed is upfront about what they're going to do, the market kind of takes it in stride. Versus on the flip side, if the Fed didn't mention anything about rates going higher and then they came out in a meeting and jacked rates up higher, that would be really, really bad for the market. So in turn, we've started to see the Fed's language change a little bit, which likely means that the Fed will do what the market is anticipating and start to lower rates in 2024. But even with all of that said, I wouldn't necessarily get caught up in what I believe the Fed's going to do or not do if I were planning on buying a house. As many of you guys know, I went and bought a house about a month ago, and I locked in an interest rate of 7%. And that's coming from an interest rate on the property I sold of 3%. Now, you might be wondering, why did I decide to do this now? Well, it was the right time in my life for one, but here's the crazy part. I bought that house a month ago at 7%. I just filled out the paperwork yesterday to refinance that same loan down to 6.5%. A 0.5% drop in just over a month from the time I purchased that property. Now, had I waited to buy that property when rates had dropped, there's a really good chance that that property would no longer be available. Now, I bought the property off market, so I didn't have to really worry about competition. But as a buyer out there, that's what you got to think about. You need to worry about whether it's the right property for you, whether it's the right time in your life for you, and whether or not it ultimately makes sense for you. But at the same time, I wouldn't be buying a property with the idea that I can only afford it if rates go down. So I'm going to buy it here, and when rates go down, it's going to be affordable to me. Because if that's the mindset you have, then you shouldn't be buying a home right now. You should continue renting. As I've said for the better part of two and a half years here, it's not always a great time to buy a home. And ultimately, you have to make the decision when it's the right time in your life, and ultimately stop worrying about what the Fed's doing, what a YouTuber's saying, and more importantly, not getting caught up in the whole idea of FOMO and missing out on some opportunity. There will be opportunities down the road. So in the meantime, focus on what you can control and put yourself in the best position so when the right opportunity presents itself, you're in the best position to move forward.